Imagine two people. Both have $10,000 to invest. Both are excited. Both do their research. Both pick what seems like a solid investment. One of them builds real wealth over the next 10 years. The other one loses most of what they put in. Not because of bad luck, not because the market crashed, and not because they picked the wrong stock. They lost because of one mistake. A mistake so common that most beginners don't even realize they're making it. And here's the strange part. This mistake doesn't happen in your brokerage account. It happens inside your head. So before you invest a single dollar, you need to understand what I'm about to tell you. Because this one idea could be the difference between building real wealth and spending years going in circles. Here's what most beginners do when they first get into investing. They save up some money. Maybe it takes them 6 months, maybe a year. They feel proud of themselves. And honestly, they should. Saving money is hard. Then they start watching videos, reading articles, maybe joining a few Reddit threads, and somewhere along the way, they hear about a stock, a crypto coin, or a fund that's been going up. Everyone seems to be talking about it. People are sharing screenshots of their gains. It feels exciting. It feels like an opportunity. So they put their money in. And for a little while, things look good. The number goes up. They feel smart. They start checking their portfolio every morning, like it's the weather forecast. Then something shifts. The price drops a little. They tell themselves it's fine. It'll bounce back. Then it drops more. Now they're nervous. They start reading more articles, watching more videos, looking for someone to tell them everything is okay. Then it drops even further. And suddenly that proud feeling they had when they saved that money turns into anxiety, stress, and regret. Eventually, they sell, sometimes at a small loss, sometimes at a big one. And then they tell themselves investing just isn't for them. But here's the truth. The problem was never the investment. The problem was that they never had a plan. And without a plan, every single market move becomes an emotional event. Let's talk about what actually happens inside a beginner investor's mind, because this is where the real mistake lives. There's a concept in psychology called loss aversion. It was studied by two psychologists, Daniel Kahneman and Amos Tversky, and what they found was fascinating. Losing $100 feels almost twice as painful as gaining $100 feels good. Think about that for a second. The emotional weight of a loss is nearly double the emotional reward of an equal gain. This is hardwired into us. Our brains are built to avoid pain more than they're built to seek reward. And in most areas of life, that's actually a useful instinct. But in investing, it becomes a trap. Here's a simple way to understand it. Imagine you're walking through a park and you find a $50 bill on the ground. You feel happy, maybe a little excited. Good day, right? Now imagine you reach into your pocket and realize you've lost $50. That sick feeling in your stomach? Research shows that feeling is significantly stronger than the joy of finding the same amount. Now multiply that across thousands of dollars, and you can start to see why so many beginners make emotional decisions with their investments. When your portfolio drops 10%, your brain doesn't say, "This is a normal part of long-term investing." Your brain says, "Danger, get out, stop the bleeding." And that voice is incredibly loud, incredibly convincing, and almost always wrong. This is the $10,000 mistake, not a bad stock pick, not bad timing. It's letting your emotions make your financial decisions. Now let's go deeper, because there's another layer to this that most people never talk about. When beginners invest without a plan, they're not just exposed to market volatility, they're exposed to something called narrative investing. This is when you invest based on a story rather than a strategy. You hear a story. This company is going to change the world. This coin is going to replace traditional banking. This sector is about to explode. The story sounds convincing. It feels logical. And because humans are wired to respond to stories more than statistics, we buy into it emotionally before we even think about it rationally. The problem with narrative investing is that the story can stay exciting even when the investment is failing. You hold on too long because you're still waiting for the story to come true. And by the time the story clearly isn't coming true, you've already lost a significant chunk of your money. Compare this to someone who invests with a clear strategy. They're not investing in a story. They're investing in a process. They know what they're buying. They know why they're buying it. They know how long they plan to hold it. And most importantly, they know what they'll do if the price drops. That last part is the key. Knowing what you'll do before things go wrong is the single most powerful thing a beginner investor can do. Think of it like driving a car in a storm. An experienced driver doesn't figure out how to handle the rain while it's already pouring. They already know. They slow down. They increase their following distance. They stay calm. A new driver who's never thought about it before panics, overcorrects, and potentially causes an accident. The market is always going to have storms. The question is whether you've prepared for them before they arrive. There's one more psychological idea I want to share with you, because it explains a lot about why even smart people make this mistake. It's called recency bias. This is our tendency to believe that whatever has been happening recently will continue to happen in the future. If the market has been going up for 6 months, our brains start to assume it will keep going up. If a stock has been climbing for 3 weeks, we assume the momentum will continue. This is why most beginners buy at the worst possible time. They see something that's already gone up significantly. They assume the trend will continue, and they buy in near the top. Then, when it corrects, they feel betrayed, like the market lied to them. But the market didn't lie. The market behaved exactly the way markets behave. It was recency bias that told them the pattern would last forever. Understanding these 3 psychological forces, loss aversion, narrative investing, and recency bias, won't make you immune to making mistakes, but they will help you recognize when your emotions are driving your decisions instead of your strategy. So what do you actually do with all of this? First, never invest money without knowing your exit strategy before you enter. This means knowing the answer to 3 questions before you put a single dollar into anything. Why am I buying this? How long am I willing to hold it? And what will I do if it drops 20, 30, or even 50%? If you can't answer those 3 questions clearly, you're not ready to invest yet. And that's okay. Knowing you're not ready is far better than investing without a plan. Second, stop checking your portfolio every day. This sounds simple, but it's incredibly powerful. Every time you check, you give your brain a chance to react emotionally to short-term noise. Successful, long-term investors don't watch their portfolios like a live sports game. They check periodically, they stay informed, and they trust the process they've set up. Third, separate the story from the strategy. The next time you feel excited about an investment because of a compelling story you heard, pause. Ask yourself, if I remove the story entirely, does the underlying investment still make sense based on logic and fundamentals? If the answer is no, the story is doing all the work, and stories can change overnight. And fourth, start smaller than you think you need to. This isn't about being timid. It's about learning. The goal of your first few investments isn't to get rich. The goal is to understand how you behave when real money is on the line. Do you panic when it drops? Do you check it obsessively? Do you make impulsive decisions? A smaller amount lets you learn those things about yourself without it costing you everything. Here's the thought I want to leave you with. The market has made countless ordinary people wealthy over time, not because they were smarter than everyone else, not because they had some secret strategy or insider information, but because they understood one simple thing. The biggest risk in investing isn't the market. It's you, your emotions, your biases, your reactions to short-term noise. These are what stand between you and long-term wealth. The investors who win aren't the ones who never feel fear or greed. They're the ones who have a plan strong enough to survive those feelings without acting on them. That $10,000 mistake isn't just about money. It's about understanding yourself well enough to not get in your own way. Because the best investment you can make isn't in a stock or a coin or a fund. It's in understanding how your own mind works when money is involved. And that investment, it pays dividends for life.